Okay, we're live. How you doing, friends? This is Ernie with the Trader of Options. This is the Zero DTE Options Talk Show, episode number 5. And today is Wednesday, June 23rd. This is one of the days that we have a zero DTE opportunity in the S&P. So what we do here, what I mean by here, is with the group of people that are in this service. Sorry. What we do here is we trade options on the last day of expiration for the E-mini S&P futures on Monday, Wednesday, and Friday. So what does that mean? That means that we are trying to put on an options strategy to try to take advantage of that event. And because it's the last day of expiration on these options contracts, that means that premium is decaying rapidly. Now you have two choices. You can work against that or you can work with it. And we choose to work with it. So what we're trying to do is use that to our advantage to collect that premium as quickly as possible. Now today's trade was probably a little bit different than the past trades that we've done over the past couple of weeks because there has been a fair amount of volatility. Today's trade was not quite like that because on Monday, the market moved up rather rapidly. I'm sorry, Friday moved up rather rapidly. Monday moved up rapidly too. And then Tuesday it stalled. But we were near the all-time highs for the S&P. And then the question is, are we going to pick it up again? Is it going to be another stall day? Don't know. So I chose to place the trade a little bit above where we stalled on Tuesday for Wednesday and see if we could capture that move. The other thing is that we're very intently looking at the global macro condition and see whether or not that will give us an edge in terms of trying to predict market direction. And that didn't really help us a lot, although there was a very negative housing report. The PMI as well as the petroleum status report were both against us. The housing was for us. Now, here's the interesting part. We're in this kind of opposite world right now where good is bad and bad is good. And where these reports, like the petroleum status report and the PMI, would have been very positive and in normal times would have pushed this market much higher and very likely have created a new all-time high, they work in the opposite way. And that's mostly because of the situation that the Federal Reserve has put us in. And that is that if there's positive news, then traders, they think that, man, that's bad for the market. It's bad because it may mean that the Fed will prop up interest rates or stop their quantitative easing. And that couldn't be good. Who doesn't like free money? And who doesn't like zero interest rates? So that's how we have to read the market. We have to look at everything in this sort of topsy-turvy, flipperootsky way that good is bad and bad is good. Now, we had a bad housing start report. It was horrendous. And I think that overall that probably outweighs the PMI and the petroleum status. But who's to know? Because the petroleum status was almost right in line with expectations. The PMI was slightly good, but the housing starts was really bad. They missed that by a lot. And that's not surprising. The cost of housing is way up. Now, some people are saying that there's, because of this pullback in lumber, that might be easing the pain of the slow start in housing. But it's still hugely elevated of where lumber cost earlier in the year. And of course, there are other materials that go into houses like copper, and copper is way up. Generally, the price of houses has gone up and the price of constructing houses has gone up. So naturally, that has stemmed the demand somewhat, even though we seem to be in this buyer's market. I think they're pulling back a little bit now. They're getting sticker shock. And so fewer builders are out there pushing or building new houses. So That couldn't be good, but it is good for the market. All right. So we didn't really have real high expectations on how far out this trade might go. So we made it just above where the market currently stands. And hey, look, if it works out, that'd be great. If it doesn't, our risk is so small that it's really not going to matter. Of course, every trade matters. I guess, if you look back at our record over the past few months, our win rate is somewhere around 85%, maybe 90%. If this trade doesn't work out today, that'll represent maybe 4 out of 40 trades or so. So we're right in that ballpark of 85 to 90%. And the trades that we've lost have all been super, super small, except for one, which was a mistake, and I've talked about that before. But even on our standards, it was still a good trade. Well, maybe it wasn't a great trade, but it wasn't a bad trade. In any event, our wins certainly outpace our wins, but what's even more important is the size of the wins. The size of the wins average about 150 to 200% of the risk that we take on. Now, that is a far cry for what most people that are trading options are looking for. Most people are looking for a 3-to-1 risk to reward ratio, where we're usually looking for a 1-to-5 or 1-to-10, or in today's case, about a 1-to-12 or so is what we're looking for. And that is orders of magnitude greater in terms of our risk to reward ratio that most people that are using traditional ways of looking at their strategies, particularly people doing the zero DTE trade. So what that means is that it's easy to develop a level of confidence with this trade, but not so easy, because it's not all just peaches and cream here. Trying to put on a trade requires a lot of work. And that's endemic in this strategy. There's a lot of work that goes into our analysis. And it's not like you just, hey, let's just put butterflies around the trade and then hope that we get lucky. Our success comes from very accurately being able to predict where price is going to be, and then placing our strategy in such a way that about 1 out of 10 times we'll pin that trade and make the maximum profit, which, like I said, can be anywhere from 3, 5, 9, 1,000, 900, 1,000%, as much as 1,500% of our risk. Very similar to our Monday trade, and in fact our Friday trade last week and the Monday before that. And we've had some extraordinary good fortune over the past couple of weeks, where normally we hit or pin these trades right on the short strike about 1 out of 10 times, but we've been doing it almost 40% of the time, which is really unheard of. Now, Monday, one of those 4 losses that we had out of the past 3 months happened on Monday, but it was a very tiny loss. And then we turned it right around with another trade that ended up winning a lot. Now, here's one of the biggest problems that we have in this service. The biggest problem that we have in this service is trying to retrain the mind of people that are actually involved in the service. Retrain them from their old paradigm of trading options or trading in general, where they're constantly trying to manage their risk. You watch guys like Oscar Carboni, who's a big futures trader, and he has a popular channel, and he says, as he should, that trading is extremely risky, especially trading futures. And he says, always put your stop in first. And that is all out of that sort of manage your risk mentality. But if you didn't have to worry about your risk, and instead of managing your risk, you concentrated on managing your profits, that's a game changer. That turns everything around. Unfortunately, most people have a hard time grasping that because they're just not used to it. It just hasn't been presented to them that way. Everything's about managing your risk. This trading thing has to be super hard. Now, I'm not saying that this is easy. I'm just saying that by placing the emphasis or creating strategies and a methodology in such a way that you no longer have to manage your risk, you shift that focus to managing your profits, it creates a much better environment, a place where you can actually develop the confidence in what you're doing. That has been the biggest challenge in this service, is to retrain people's minds from going from that manage risk mentality to letting that go and then just manage your profits. And not only that, but not having to hang on every single trade. If I don't win this trade, it's going to be over for me. I'm risking my whole account, or I can't take another loss. And I'm sure that a lot of people that are coming into this service have felt that way in the past, and they're hoping to look for a better way, and they're always looking for a better way when you try out a new service. You're hoping that's going to provide you with the finally, they're going to bring me to the promised land. Now, of course, even with good trades or good setups or good calls or good alerts, if you don't have that right mentality and you're not going with the methodology and you don't really understand it and you're still in that old paradigm, you could take great trades and still lose. That's why it's, like I said, it's the biggest challenge, to get people to divorce themselves from that way of thinking and start thinking about managing their profits and understanding the methodology, understanding what your edge actually is, and then the work that's required to get into these types of trades. And that's the key part here. There are essentially two parts to this trade. Of course, we have our overall strategy, we have our methodology as traders and how we manage our own accounts and our risk, our capacity for risk and our tolerance for risk and so forth, and we decide how big we can make each one of our positions. But the strategy itself really comes down to two things. One is being able to analyze the market structure, right? And in other words, being able to tell where the levels of support and resistance are, where's the most likely place that that price will end up in that particular session, given the direction and magnitude of velocity of the stock or the price or the asset going across that structure, right? You can think of it as a landscape. If you have a very smooth landscape and then you push a cart across it, it's going to go nice and smoothly. So if that's what your landscape looks like and the direction and velocity of that cart is set, then you have a pretty good idea of where it's going. But if it's a very bumpy and hilly landscape, you're going to have a different expectation about where price or that cart is going to go when you give it that initial push. And I guess that's like the best analogy that I can give. So our job is, first of all, to figure out what that landscape is. And so we do that through this analysis of the volume profile. And I provide a mini course in this service where everybody will learn and then see by doing how to analyze the markets and create that market structure so that then we can create scenarios, what-if scenarios. If price comes up to this point or if price moves across this point, etc. The next thing that we do, the next part of that equation, is a full understanding of the global macro condition. So what do I mean by that? The S&P, the biggest index in the world, is influenced by a lot of things. It's influenced by economic reports. It's influenced by economies, energy consumption, by sentiment, by monetary condition, by politics, by a whole host of different things. And getting your head wrapped around that is a task. We try to figure out what are the most impactful things that might set price off into a particular direction in a certain velocity or magnitude. And we do that by analyzing all of these different global macro indicators. We analyze the market. We analyze the reports. We analyze the current market condition. And then that's our cart. That's the cart or the car that we place and push into the landscape, so to speak. And we decide what direction it's going and how hard we're going to push, all based on this global macro analysis. And that is not a trivial thing to do. So, yeah, you can have this perfect landscape if you know it like the back of your hand, but if you don't know how that cart is going to go across it, you could have a miss. And anything can happen along that journey, too. Anything can happen. It's not like a static system where you know all the variables and you just turn it on and then it gives you an expected result. Anything can happen during that. And so because of that, we develop what I would call scenarios, maybe 2 or 3 different scenarios. Usually those involve the bullish, the bearish, and the neutral case, or maybe the bullish, the really bullish, and the not so bullish in the neutral case, depending on where your bias lies. So that, again, is something that is different for an options trader, is probably more steeped in the type of strategy they're putting on, whether it's a neutral or a directional strategy, and what are the probabilities and so forth. And that's one thing I wanted to talk about, probabilities and what in your options chain and the delta and probability of profit there. I'm going to say right out that I think that most of the probabilities that you see in your platform are total bullshit. I'll venture to guess. It's not really a guess because I've done the studies. I'll venture to say that the probabilities of, say, taking a purely bullish or a bearish position that are stated in your platform are completely wrong. In general, the probabilities for bearish positions or any put, for instance, are definitely understated. So in other words, if the probability is, say, and let's just take the short case. So we're always dealing with short cases because we collect premium, right? So we're net sellers of premium. So short puts, if the probability is, say, somewhere around 50 or 60%, I'm going to venture to say that it's probably a good 20 to 30 points higher than that. So there's a definite edge on the put side. On the call side, it's exactly the opposite. Let's say that the probability is 60 or 70%. I'm going to venture to say that it's actually lower than that it's probably closer to 50%. And this more or less falls in line with, what we normally see and expect and see the skews of our trades and our analysis. While you can take the probabilities as maybe a guideline or with a grain of salt or understanding of what the reality is, they are, in most cases, generally useless to the options trader. And I'm sure that there's going to be plenty of people out there that are going to vehemently disagree with that notion. They're going to say, Ernie, you are so wrong. It's all about the statistics. I don't give a fuck about the statistics. If in real life I know how these things act, and I realize it every time we take a trade. You can see it. So for those people who are putting on trades that have super high probability, choosing a 5 delta spread and then constructing an iron condor with that and thinking somehow that they are going to have a 95% probability trade because they put these 5 delta spreads on either side flanking their iron condor. I'm telling you right now that the put side of that credit spread is very likely to fail. And the call side of that is probably going to come up short. But the chances of you staying in the middle are very low. And more often than not, you're going to be run out and hit your whatever stop that you've conjured up because you can't figure out why these high probability trades aren't giving you high probability results. And then you'll put a stop and then turn it into some sort of a Frankenstein of a position. That's how most people are trading the zero DTE. And they're trying to manage their risk because they're putting themselves into risky positions with insane risk to reward ratios where their risk is literally 9 to 10 times their reward. And because they are so skittish about grabbing whatever premium that they can collect on it, putting on these high probability iron condors, their potential collection of premium is very small and their risk is very high. So they try to get in and try to get as much as they can and grab it as soon as they can and then exit from that trade as soon as they possibly can, which usually means that, hey, once we hit that 25% of premium collection, we're out of there and count our, blessings. And that's usually the way it works out. They count their blessings and they get the hell out of there because they know that at any point, price could go to the left or to the right and then start challenging their wings and potentially put them into a max loss, which could wipe out literally months of their profits. That's what they do. That's trading scared. That's trading the way most people are used to trading, I guess. That's trading completely the inverse of what we do. And that's why I call it the inversion of risk philosophy here. Anyways, that's what we do. We got a few questions, answer them. And let's see, today's trade, where are we, by the way? We're struggling to break out to those new highs today. It's possible. It could be that this trade is a bust, and that'll be a shame. But we are definitely struggling to tip the hat. So we'll see. There's been this kind of pattern where at the end of the day, there's like a run, either up or down. So let's see if that works in our favor today. All right. So let's see. Some questions. Tobias is saying 85% win rate. How does risk reward usually look? Well, I think I explained that. Yep. 85% win rate is about right. So in other words, out of 10 trades, we're winning 8 to 9 of those trades. And how does the risk reward usually look? Usually 1 part risk to about 5 to 10 parts reward. So while we're not always hitting the, pinning that trade on the max reward, there's a spectrum in between. And so about 80% of the time, we're somewhere in that spectrum from the low end of, say, 100% return on our trade to, and that's about the minimum that I've noticed, about 100% return on our trade to as much as 900, 1,000, or even 1,200% or more of that trade. So that's basically what we've been doing. It doesn't look like that's going to happen today, though. But you don't see anybody sweating this. You never know. We've had some strange trades, I'll tell you, that right at the end of the day, and there's still an opportunity here, even if we do not break out of this little funk, this little second day of consolidation, I guess you could call it, we can still come up with a last-minute trade that we can recover the tiny loss and then maybe turn it into another 100% winner. We'll see. Let's see. Ken saying, I know it's simple to most, but how about a video or Zoom session on placing and closing butterflies on toss? Yeah, we'll do that. We will definitely do that. We'll do that in our service. If you'd like me to do that this week, maybe I can arrange that for tomorrow. I have done that before, by the way. We have done a similar exercise before, and there's probably something inside of my YouTube channel talking about that, but we'll do that. Let's see. Do you show the analysis behind the trades, or is it just signals? No, as a matter of fact, I don't like to call this a service. This is really a learn the strategy service with alerts to demonstrate the strategy. So it's exactly what you're asking. There is complete transparency on everything I do. As a matter of fact, I spend an inordinate amount of time going over the analysis and all of the global macro analysis, as well as the volumetric or volume profile analysis. And we do all of that. And on top of that, I'm available to every single member in the service at any time, either through the Discord. I even provide my personal phone number. And people can call me. They can also set up a one-on-one session with me at any time. All right? So all of that is true. Let's see. How much is the service? New to the channel. The service, first of all, the entry into the service, you can either go right into the service, and this is good until the end of this month, so for the next week. You can either go right into the service, and it's $250 up front and then $64 a month. The $250 is supposed to cover the support and service. You can also start off with a 4-week trial where you spend $20 a week and then you're a part of the membership like everybody else, except for the one-on-one training. Everything else is exactly the same. And you can participate. And if you go at any time you want to go and join the service, I will take whatever you spent on that $20 a week and apply it towards the service. So it ends up being so basically you get that trial for free. Now, there's going to be a slightly different deal. It's still going to be a 4-week trial, but up front it's going to be a little bit cheaper at the end of this month in July, but you won't get the refund on it. So it'll be slightly different. Plus, I'm going to offer a quarterly and a yearly because some people have been asking for that. If you want to start right now, I think that's the best deal right now. And for a monthly user, you can do a 4-week trial and you can start right today. And the links are down below. Just go to zerro-dte.com. All right, let's see. Can the strategy be applied to stocks, and would it have to be placed on Fridays? Yes, it can be applied to stocks, and no, it doesn't have to be applied to Fridays. As a matter of fact, I have another service that does exactly what you're talking about, and it's called the 3D options service. It uses a lot of the same methodology and strategy, and instead of being a 0 DTE, it's a 7 to 21 DTE. And we apply many, like I said, many of the same strategies and everything. Of course, we're not trading the S&P. We're trading highly liquid stocks. And we're not always trying to pin it right to the last day. We're trying to capture as much premium as we can, as quickly as we can, through a lot of the same methodology. Basically the same strategy. Yes, it's a more generic strategy that can be used across a lot of different things. Mario is asking, your strategy is mainly selling options to collect premium. Yes. So the max gain results when the options expire worthless and you keep all the premium. Well, that's when the max gain, yes. So the maximum gain that you can get. So for instance, on Monday, we were able to actually pin it right on those short strikes, and the strategy, gone into that strategy, both of your positions would have expired worthless, and you would have collected about $1,100 on about $125 risk. So yeah, that's basically what would have happened. Now, most people in the strategy got out earlier than that because they weren't willing to wait right to the very end. And so they made 400, 500, 700% risk. As a matter of fact, that's what I did. I got out at 400% and 700% of the risk taken. Still, excellent return. I know that there are a couple of people that held right to the end and gained the max. How much capital do you need to enter a trade? As I said, most of our minimal position size for most of the trades that we put on is about between $100 and $200. So today was a little bit of an exception. It was much lower than that. You could have got in for as little as $25 or $50 for a potential return of about between $200 and $400. And that's mostly because of the position we're in. I didn't think that it was worth challenging that much. It was indeterminate where the market was going to go. I couldn't tell if we were going to break out again or if we're going to just consolidate here. So we're just taking a small. So yeah, you don't need a lot. But by trading futures, most brokers would require you to have an account with at least a couple of $1,000s in it. Now, depending on the broker, I know IB, Interactive Brokers, requires a lot more. TD Ameritrade only requires that you have $2,000. I think that Tastyworks is about the same. I'm not sure if they have a minimum, but you don't really need a big account, and you can get into the trades with a very small amount of money. Yeah, that's right. $115 risk to make 1.1K reward. Yes, that's exactly what the Monday trade was. So you want to close the trades before the market closes to avoid assignment, and yet want to wait for possible late moves. Approximately what time do you put in closing orders? You could put it in right up to the very last minute if you wanted to, if you're confident that you can get it, if you're confident that you can actually close the trade and get a fill. I would probably do it 5 minutes or 10 minutes before the market close. But it's amazing how much more, if you're pinning it right on the short strike, it's amazing how much more you can collect every minute that you wait. And we saw this last week or the week before, that almost every minute resulted in another $50 to $100 if you could just wait that last couple of minutes. If you're so worried about grabbing that extra little bit of money, then this is probably not the place for you. It's because there's going to be these kind of opportunities all the time. You don't have to grab the max out of every trade. You would like to, but if you can't be satisfied with 400, 500, or 600%, then maybe there's something wrong. Maybe you have a gambling problem. Let's see. What's your rate of return year to date, if you don't mind? I'm very interested. My rate of return. Not sure exactly how to. I. It's going to be different for everybody, first of all, because first of all, it's discretionary about when you actually get out. So everybody has a slightly different thing, you know. I'm just saying that I've been averaging about 150 to 200% return on every trade that I put out. So that's basically, I guess, the rate of return. Average trade, counting all trades, about 150% of the risk that we put on. So let's say that we were talking about an average of $100 putting on the trade, an average return of about $150. You might want to switch to autofocus from fixed focus. Oh yeah, look at that. I have a new lens coming that's going to take care of that problem. So just got this new camera, still getting used to it. And there's the sorry about that. It'll get better. I just got all this new equipment. I got the new Shure mic. I've got the new Sony camera, and I'm still working on fixing up the studio, but it will be much higher quality as we go forward and I get better at it. All right. Are there any more questions? Cool. So thank you very much. If you don't mind, if you like what you hear today, please hit the like button. I'd really appreciate it. Helps the channel. And if you would like to try out the service, the 4-week trial is really a low barrier to entry. Even if you don't take a trade, just to watch what's going on. But most people have made enough in their trial to pay for a year's worth of the service. Wow. Since starting with Ernie 5 weeks ago, I am a total of a 697% return. There you go. It's a great methodology. I don't know what else to say. It's like chess. It takes 30 minutes to learn, but a lifetime to master. I'm not saying it's going to take a lifetime to master, but I think that most people can get good at this and develop the confidence in themselves as well as the execution strategy, the execution skills and the strategy skills probably within a couple of months, few months, and then you just get better. It should be 4 to 5 times that. I'm one of those guys that is bailed out early. Yeah, and like I said, that's been one of the biggest problems. Some people, they bail out early because they're afraid of losing. They're trying to manage their risk instead of just take each trade for what it is. Go into it small and hopefully you come out big. Rethink how you're trading, that you're no longer managing risk, you're managing profits. That's about it. All right, I'm done here, I believe. All right, let's end in focus. Again, thank you very much for coming. Please hit the like button. Really appreciate it. And there's the off button. Thank you. Take care. Have a great day. We'll see you Friday.